The bigger issue is actually, for the economy at least, is the amount of debt in the system. So, one thing I've been watching even prior to this pandemic was that, GDP growth was declining in rate of change terms. So we were getting GDP was still going up, but it was slowing compared to where it was in prior years. And then also, we have a historically very large amount of debt in the system. And so, there's the short-term credit cycle where businesses and households build up debt, and then there's some sort of deleveraging event and a recession, and they end up paying down some of that debt. But over time, those debt cycles tend to build up on each other, so they never fully deleverage, and they just kind of deleverage half the way, and then interest rates go down, and then they build up even more debt, and so there's kind of this toxic mix. And after a very long time, there's so much debt in the system, and interest rates hit zero. So it kind of hits that hard wall. And that's kind of where we've been over the past, 10, 12 years. We've been at kind of the apex of like a long-term debt cycle with a very huge amount of leverage in the system. The virus comes along, and then, that would have been kind of easier for the world economy to deal with if it wasn't for the fact that there's so much leverage in the system, both in corporate balance sheets, household balance sheets, and then even on sovereign balance sheets. So a lot of things are kind of playing out in a similar way that I thought. Of course, the virus was a curveball, so you had kind of some industries get hit harder than I would have guessed, and other industries benefit more than I would have guessed. But the overall macro environment is really not that different. I think it kind of pulled forward stuff that I might have expected to happen over 2 or 3 years into the first half of this year. It'll be fine eventually, but it goes through a process that can be very messy in order to get to that next fine level. And also it depends where you are in the world, because different places will have different responses. Some places are always going to be more fine than others. Of course, there's some places where it ends up not being fine, but in most places it ends up being fine. But it's not without kind of a hard challenge ahead. So historically, when you get to this high of debt level, it's so high that it can't really be deleveraged without kind of a full system crash. And what they end up doing in practice usually is the currency itself gets devalued. So, the last time we had debt levels like this was back during the Great Depression and World War II era, and they ended up devaluing the dollar versus gold, and then treasuries underperformed inflation, on average for a couple decades there. And so we've seen that kind of play out in a lot of different countries as well. If you go back through history, there's even kind of case studies in like ancient Greece and in Athens, for example, like 2,500 years ago, where they had the same problem happen and they ended up devaluing their currency. It's just it's a cycle that's kind of as old as civilization, where you have these big kind of debt pileups, and then usually there's some form of deleveraging, which at these extreme periods ends up involving currency devaluation. Yeah, so back in around summer, autumn of 2018, I turned pretty bullish on gold and silver, and so we added the gold, the silver, and some of the miners as well. And so over that time, those have done very well. We're kind of currently in a consolidation, right? Because we at the last month or so, the prices went up pretty fast, pretty quickly. And so in some ways, they kind of reached overbought conditions in the near term. So I wasn't surprised to see a pullback. And I don't know if that pullback's over. I think I always kind of say it depends what happens with fiscal, right? So if you have kind of a more deflationary shock, people often think that gold is going to protect them in kind of all conditions, but it really kind of, so as kind of an insurance, it protects in all conditions pretty much. However, the paper price of it can fluctuate and go down briefly during big liquidity shocks. So if you look what happened in March, for example, we had that big deflationary shock. We had a decline in the gold price. And it was interesting because there was a big divergence between the price of physical gold and silver and the price of ETFs and futures and other kind of more paper products. So if you were trying to buy gold and silver during that sell-off physically, you couldn't really find it in most places. And if you could, it was way higher. So actually physical kind of coins went up in price, even though if you're looking at the ETFs or the futures, it took a pretty big dip, especially silver. It was actually a really good buying opportunity. And then when we had that kind of policy response, so they started to kind of expand the money supply and kind of throw money at the problem, then of course you had gold and silver and the miners explode back up, right? Because they never really should have been down there in the first place. That's what happens in liquidity shocks, is people kind of sell whatever they can, including their gold and silver, just to get cash to meet margin calls and other things like that. So for people that are unleveraged and they can kind of wait that out, that was a very good buying opportunity and holding opportunity to kind of wait for that rebound. And I think, it's possible we could repeat another one of those events to some extent. If we get kind of another kind of solvency event, I wouldn't be surprised to see kind of consolidation or pullbacks in some of the precious metals temporarily. And I would view that as another buying opportunity. I think physical is great to hold where possible. There's also kind of funds and miners you can get to get exposure. Longer term, I think that likely gold and silver are still kind of going to do pretty well because I don't see this expansion of the monetary base kind of ending anytime soon. I think they're going to probably run very large deficits. A lot of it will be monetized, and we're probably going to have negative real rates for a while. So gold tends to be very correlated with kind of inflation adjusted interest rates. And I think that because we're probably going to have long stretches of those being negative, I think gold can do very well. But I think that there could be kind of pullbacks and more deflationary shocks along the way. I think it could definitely happen, especially if you look farther and farther out through the decade. I've kind of been tracking the money supply growth. Over the past month, because we've had kind of that fiscal gridlock, we've actually, money supply growth was increasing very quickly earlier in the year, and the past month or so, it's been kind of static. So, if we have one of these more deflationary shocks, I wouldn't be surprised to see the pullback. But I think longer term, we're going to see the money supply continue to ramp up pretty quickly. And so I think gold and silver are pretty good ways to hold your purchasing power, at least as part of a diversified portfolio. I mean, it's not the only thing I'd want to hold, but I expect over the next several years, I think we're still in the first half of this run. I think gold could reach at least high to the 2000s, and then potentially far higher if there's more of a sentiment-driven kind of euphoria for it, and especially if there's kind of a more significant currency devaluation. So I think, pretty much regardless of where I was in the world, I'd want to have a pretty good amount of gold and silver exposure, and then exposure to some of the miners as well, because that can give you a little bit more upside potential if you're willing to kind of stomach that volatility. And even if you look at, some of their prices, like GDX, the ETF for gold miners, fell more than the broad stock market did in March. So it went down dramatically. It was just like an incredible buying opportunity. And so, we've had a sharp rebound then. So if we have kind of another kind of one of those scary moments, I think I personally would view that as another good buying opportunity. So I think long term, I still think we have kind of a pretty good upside potential here. I don't really use specific price targets because it partially depends on what happens with fiscal spending. I still think that the kind of the end of this run is probably going to be notably higher than now. I think that will probably happen eventually. I think the timeline's unclear, and I think, of course, every country's different. So it's kind of funny how quickly that came about, because when earlier this year, when Andrew Yang was proposing that, it was kind of like, people were like, yeah, cool. And then months later, you had Democrats calling for it, and you had even Republicans calling for it, at least in a kind of a moment. So everyone was kind of like, how Andrew Yang are you? Like, some people are like, oh, I'm more Andrew Yang than Andrew Yang was. And other people were like, and then you had the fiscal conservatives that are like, I'm only like half of Andrew Yang. Like, I only want to. So it was kind of that big changeover. Now, of course, his was a more permanent plan, so he wanted to have that continuously, whereas this was more of a kind of a response to this pandemic.